And there we go. Okay, cool. All right. Well, welcome everybody. You are on another edition of Wealth Wednesday. Tonight we're going to be talking about banking, banks, banking industry, what we need to know as consumers and really customers. And the Wealth Wednesday conversation, we typically do these on the second Wednesday of the month from 6 to 7 p.m. Pacific. And really the whole intention of this conversation is to raise our financial IQ and be more aware with our money and our personal finances. And we launched this at the end of last year, and we've been doing it every month. And I'm bringing on a different expert to teach or lead the conversation around different subjects that are important to us. So it's pretty casual conversation. There's no really set rules of engagement other than being respectful to one another. Don't be shy on the questions. Odds are, if you've got a question, someone else in the meeting's got the same question. They probably just haven't asked it yet. So you can pop a question in the chat, or you can, raise your hand or just kind of chime in. But these conversations are for the audience and for the network. As a 20-year mortgage professional, I look at people's finances for a living, and it's just stuff that we're not taught in school. And looking at people's credit reports and tax returns and financial statements, there is a lot we could all learn. So that was kind of the thrust and the reason for these calls. Tonight, we're going to be talking about the banking industry. I think it's really important given what's gone on in the last 60, 90 days with some of these regional banks. Being completely transparent and authentic, I bought a bunch of First Republic stock thinking that I was going to be a hero, and watched that go to zero and lost a small car in the amount of cash in the process. I think that this call will be good for us to know how do banks work, what happens when we give banks our hard-earned money, what can we do to protect ourselves, and is there any opportunity here? And so, with that, I'll introduce our guest tonight, who is Matt Rinke. Matt is a local financial planner. We're the top guys in Southern California. I've known Matt for, 7, 8, 10 years now, maybe. But good guy, owns his own practice, is independent, which I like. So he's not at one of the big wirehouses where there's a certain agenda. So you tend to kind of get a non-biased opinion of things. And so feel free to ask any questions you like. But Matt, thanks for taking the time, and thanks for coming on.
Yeah, no, thank you for having me. It's been obviously a hot topic of conversation, and one that no one really wants to have. Is my money safe and secure in the place that you think it should be the most safe and secure? So nonetheless, here we are. But yeah, thank you for having us, having me, and having the community around us. I know these conversations are very important, and as you said, how do we grow our financial intelligence? And looking forward to today's conversation and answering questions and learning along the way from all of you as well. So looking forward to it.
Great. Thank you. It's, and I think you picked a great point to start at. It's the place that we think our money and our cash should be the safest. We're learning might not be the case. Maybe it is, but there's probably more for us to learn. So maybe why don't we start there, Matt, and maybe just share a little bit of how do banks work? Like what happens, when, you're 10, 12 years old, and hopefully one of your parents walks you into a bank and says, all right, kid, open up a savings account. And you're going to put, your chore money in here.
Yeah.
How does that all work? Then, really what happens from there?
Yeah, absolutely. Yeah, it's really interesting to think about. Like when we go to the bank and we deposit our money or get a direct deposit, goes into, your own account, your own bank account. And everyone thinks that this is a safe place for my money to stay. The safest place is to keep my money in the bank. And, what's interesting though about banks is banks are really an intermediary. They take your money, you go and take your money and deposit it. And then from there, they go and use your money to then invest and lend other people money. And so the way that our economy works is through lending, through being able to create more money. And the banks are a vital source of being able to help our economy work, because for many of us probably on the call, right, they're lending money so that we can get a loan to start a business, so that we can get a loan to buy a commercial property, or to get a loan to get a mortgage on our house. And so the way that the banks work and the way that they make their money is by getting a deposit from you and perhaps putting your money into an account, and it may or may not pay any interest. So back in the day, there used to be a lot more interest on even checking your savings accounts than what you might be experiencing now. So you take your deposit in, they give you a little bit of interest rate, and then they would go and lend that money out longer term and earn a higher interest rate. If they're giving you money at 2%, they're lending it out at 5, 6, 7% on their loans, and they're making the difference in between. And so, yes, despite the fact that they're taking your money and lending out, they're obviously keeping track of everyone's deposit across all of their client base and across all of their different institutions. And so these banks are really simply an intermediary. And what happens is your deposit becomes the bank's liability. They got to find a way to give you your own money back at some point in the future. And so what happened lately was a mismatch between how the banks accepted their deposits and all the client liabilities that they had in terms of deposits, and how they then invested their money or lent their money out. And that caused a little bit of a problem. And so, yeah, the bank, when you give money to that bank, they are not keeping all of that money sitting in a separate account that's tracked exactly against the amount of money that you deposit. They don't have every last dollar of client deposits on hand to give it back to them that same day, because they are lending it out or investing it for other purposes.
And isn't that, part of the problem, that like how we saw some of this unravel pretty quickly, back in late February, early March?
Yep. Yeah. No, you're absolutely right. I mean, that's a huge part of the problem is that it's part of the reason why the economy grows and lending happens, but it's also can be the problem, and banks can fail. And, banks as of late, they've become insolvent because of this problem. And what happened lately, what happened with like Silicon Valley Bank, for example, is that they had all of these different companies and all these different individuals give them deposits. And so a lot of their deposit base were companies, and these companies had deposits at the bank well in excess of the FDIC insurance limit. And maybe that's something that we want to talk about here for a second.
Yeah.
Is when you go to a bank, almost all banking institutions are FDIC insured, and they need to be, kind of licensed and regulated under the FDIC. And each bank account basically has $250,000 of FDIC insurance. So if I go to the bank and something happens to the bank, my money is protected up to $250,000. If the bank fails, like we saw with Silicon Valley Bank and First Republic Bank, that if I have $250,000, they will ensure that I get my $250,000 back. Now, any amount above and beyond that, if the bank fails, is not guaranteed to get any return on that money if something goes wrong. Now, it's worked out okay for depositors in that sense, but at the same token, it becomes a risk. And what happened with Silicon Valley Bank is that 96% or 90+% of their deposits were deposits in excess of that FDIC insurance limit. So all of their deposit base, when they started to hear about the fact that the bank was losing money on its investments, in simple terms, those depositors started to get scared. They started to get scared because if their money is above and beyond that FDIC insurance limit, and this bank is having trouble with its own investments, how are they going to be able to give me my own money back? And so all these different companies, all these different people that had deposits at Silicon Valley Bank decided to pull their money because they were concerned that they wouldn't get it back. And so when that happened, it essentially created a run on the bank. And Silicon Valley Bank, what they have to do is they've got to sell those loans, sell the securities that they took your money and invested in to be able to get cash back to pay all those depositors leaving back. And so, one, it's not always easy to sell illiquid assets and loans. And two, by them selling those assets, they had to realize losses because of the assets that they had went down in value. And when they go down in value, it reduces their capital, it reduces the equity on their balance sheet. And so all this was a very quick little spiral that happened. And the big issue is because they had so many people on deposit that had most of their deposit base was well in excess of that FDIC insurance limit. And it scared a lot of the depositors and thus kind of created that, that eventual bank failure.
And kind of like snowballs on itself pretty quickly.
Yep, it really does. It's almost a self-fulfilling prophecy.
And if we back up a little bit,
yep,
wasn't part of the greater issue the rapid increase in interest rates?
Yeah, that definitely was a big reason why these banks ended up getting into trouble. So, banks utilize the Fed for their own operations, right? They can borrow money from the Fed and from the government to, satisfy their, capital needs on a short-term basis. And oftentimes what happens is that a bank takes in a deposit. So I go and make a deposit at the bank. They pay me 1%, a small amount of interest. And then what the banks did back in 2020 and 2021, when a lot of this PPP money was happening, when a lot of free money was being out there, the banks took those deposits and then they invested in long-term government bonds that might have been paying 3% at the time or 2% at the time, very long-term bonds while interest rates were really low. So then what happened is that the Fed started to raise rates. And when the Fed started to raise interest rates, the investments that the bank made, the bank that invested in those bonds, what happened was the value of those bonds go down. So there's an inverse correlation between interest rates and the value of a bond. And so they invested in bonds, interest rates went up sharply and dramatically, which then reduced the value of the bonds and the investments that they made with their money. Now, if they had the ability to hold those bonds for the next 30 years, they would have never lost money. They would be perfectly fine. But there was a mismatch between the fact that they own 20 and 30-year bonds and they needed to get people's money back today, now. And so that kind of created this run on the bank. So the rise in interest rates absolutely created the issues at a few of these underlying banks. Absolutely.
Yes, it sounds like the perfect storm.
It certainly was. It certainly was.
So now I don't know the number off the top of my head. I don't know if it's 5 bank failures that we're aware of between First Republic, Silicon Valley Bank, and Signature Bank, Credit Suisse. Where do you think we are with this? I mean, I gotta think there's going to be other banks that go down or come to light with some major issues.
Yeah, for sure. I mean, there's no doubt that there's other banks that have issues. Now, whether things can be hidden under the rug for a period of time, very well could happen. But there's likely that other banks have similar issues to these other banks. Not all of them necessarily are public companies that have the financial reporting that everyone sees and all the different investors and analysts are looking at, like Silicon Valley Bank had, or like First Republic Bank. But there's certainly other banks that have some of the same dynamics, that Silicon Valley Bank had, right? Like how much of the balance sheet is uninsured deposits, right? State Street has a huge amount of uninsured deposits, but it has very little, the balance sheet doesn't look as challenged as what Silicon Valley Bank had. And so it's like, where might some of these other issues be? City National Bank is a lot of real estate investors utilize them. They're pretty big in Southern California. They have 70% of their deposit base is in excess of the FDIC insurance limit, compared with 96% or 95% at Silicon Valley Bank. Now, City National Bank has about 95% of its money in loans and these long-term held to maturity, securities as a percentage of their deposit base. Silicon Valley Bank had 94%. So there are definitely potentially some other banks out there with, similar issues. Now, I think one thing that we need to step back as a depositor at these banks and say, am I going to be okay? Is that in all of these situations, what's happened as of late, the Fed has provided a backstop to not only that $250,000 limit, that they've made sure that everybody on deposit is made whole, right? So even if these other banks have issues, has the Fed already set a precedent that, that they're the FDIC, if they already set a precedent that they're going to make sure that everyone's money will be made, every depositor's money will be made whole.
The Fed to the rescue.
Right. Absolutely. Now, I think a good thing that's happening as all this is that all these banks now are getting a tax because to help replenish the FDIC, for them having to step in the situation that they have. Hopefully that doesn't flow back to the underlying consumers in some way, shape, or form, and depositors, but the banks are going to need to be paying their own little tax back to help, bolster the FDIC even further.
Yeah, it almost seems, inflationary in nature and contradictory to what we're trying to do to bring inflation down currently.
Yeah, exactly. But at the same time, banking having its own challenges becomes a deflationary situation because less lending happens, and that by in and of its own self slows things down, right? People tighten their lending standards. They're not going to give out as many loans. They got to be a lot more safe with who they provide capital to. That then has a deflationary impact on the economy, which can hurt when an economy is already slowing down, obviously.
Yep. All right, we had a question here from Ron. How many failed banks would it take for the FDIC not to be able to pay back depositors in 200K?
Yeah, that's a good question. I mean, there's so many deposits. There's so many money market funds which don't have FDIC insurance. There's like 5 trillion in money market funds that are only protected, up to a certain margin. But it's hard to see a situation where the Fed wouldn't step in, and the Fed has the ability to print an unlimited amount of money, which would be completely, inflationary. I don't have the exact answer, but that's a pretty good question. It's a pretty good question.
It's a good question and daunting to kind of think about.
Yeah, absolutely. Right. Because it's a fractional banking system, right? We only need to keep a little bit of the cash on hand that the people deposited so that we can lend it out to keep the economy going. It is,
Can you speak on that for a minute? Do you, and not to put you on the spot, do you know, is there a formula for how much they need to keep on hand versus what they have taken in?
Yeah.
You went off the gold standard obviously 50 years ago, and that changed everything.
Yeah. I think a bank needs to have like 10% equity, right? So it's almost like it can have a 90% loan to value. A bank.
That's so crazy.
Yeah.
As a mortgage person, someone getting a mortgage for 90%, unless you're a first-time home buyer and you're really trying to make it happen, pretty risky to do.
Yeah. So your banking institution,
but an American bank can take our money and be leveraged to 90%.
Yeah, it's pretty significant. It's weird to think about that in that case, right? They only have, and of that 90%, which is where you can see how banking become insolvent pretty quickly. They invest those assets into long-term bonds. Those long-term bonds, a 20-year bond has a duration of 20 for every 1% rise, duration of 15. A 1% rise in interest rate has if something has a duration, which is like the term of the bond, that has a 15-year duration. If they invest in long-term bonds, a 1% rise in interest rates will reduce the value of that bond portfolio 15%. So if they have their deposit base in long-term bonds that just dropped 15%, their entire capital, their entire equity is gone. And so then everyone's thinking, my bank is now insolvent. I need to get my money. That's the situation. That's what happened.
Wow.
Yeah.
Eric, do you have a question or a comment?
Yeah, I was, if it's okay to
Yeah.
sort of ask a question comment here.
Sure.
I want to try and ask this intelligently and not to stray into conspiracy theory too much or whatever, but I read a book some years ago that was basically about the creation of the Federal Reserve System, how it was sold to Congress and to the American people back in 1913. And it's my understanding that prior to that, bank failures were quite regular. And the way that the whole thing was sold to us was that, the Federal Reserve is going to sort of smooth out the rough edges in the system and create, like you say, a backstop. And then, of course, ever since 1913, we've seen a series of bailout after bailout after bailout after bailout of various industries, banks, railroads, steel companies. I mean, you name it, they, something crumbles and they bail them out. And essentially, we're all paying for that in the decreased spending power of the dollar. Is that anywhere close to accurate?
Yeah, for sure.
Okay.
Yeah. Oh, I mean, over time, I think what the Fed has taken on as their job is probably much broader and perhaps even more politicized than it ever was. They're supposed to be independent, and their involvement is undoubtedly magnifying everything. Now, it's in some cases they're necessary, but in other times it's just creating these cycles, these boom and bust cycles, and they're likely the biggest driving force behind all of it.
Right. And I think a common misconception, maybe you already said this, and I'm sorry if you did, that the Fed is not part of the federal government. It's a private bank, right?
Yeah, it's correct. Like the Fed is its own body. It's
right.
Its own body. The government appoints people to lead the Fed, and
sure. It's a body of unelected officials that are appointed by elected officials to manage our money. And it always seems like James was saying, I mean, we're not allowed to leverage 90-10, but the bankers are. So, I mean, it's a system that definitely favors them and probably should, to be fair. But like the Ron asked the question, how many failures does it take to collapse the whole system? I think we seem to be darn determined to find this out, because the savings and loan industry in the 90s collapses because some regulations or regulators aren't keeping their eye on a certain ball, and then we think we have it all ironed out in 2008 with Dodd-Frank and everything else, and now all of a sudden come to find out, whoops, we weren't watching this, so now we have more banks failing. It seems to just be sort of a self-perpetuating cycle that there's certainly no answer to it. And again, I guess it's more of a comment than a question, but it's a fascinating topic.
No, for sure. And I think, there was Dodd-Frank, following the global financial crisis. And then there was some deregulation that happened in the last handful of years. And the deregulation that happened exempted banks with a certain, that were below a certain size limit in assets. And then banks like Silicon Valley Bank were exempted from some of those more stringent regulations and capital requirements and stress testing that needed to go on. And so, all these things, played a part, played a part in what we're experiencing now.
Yeah. I'm going to put a link to that book that I was talking about in the chat. It's to be 100% transparent, I couldn't finish it because it made me so angry, but I got too angry after reading reading this, but it really is fascinating to read about how this was conceived and created, and who was doing it, and basically whose idea it was and how it was sold to us.
Yeah, thank you.
Yeah, feel free to share.
Okay, cool.
David, do you have a question or a comment?
Teeing off a little bit on Eric's comment, a couple of things. I don't think there's much political appetite for moral hazard. So we're gonna see ways of covering up, and as long as we can print money, that's easy enough to do. Just monetize the problem.
Yeah.
It seems clear that even noble institutions like Goldman Sachs are perfectly happy to come up with schemes like securitizing bad loans, which clearly to any simple-minded observer makes no sense at all in the long run.
Right.
When I started in my business in 1982, banks held on to their debt. They had loan committees. They evaluated the risk, and they used the income from that to make other loans. It's a system that worked reasonably well, but didn't provide as much capital as the current scheme. So given this reality, which we're not going to change, what do we as individuals do? How do you evaluate a bank and know that what they're doing is not crazy?
Yeah.
Or any other, or for that matter, any other company in which you're going to put your money.
For sure. Yeah, no, that's a great question. Obviously that it's not necessarily easy, or everyone's been trading, but there's ways to, kind of read a balance sheet. But even some of the pros, right? No one was looking at Silicon Valley Bank until, an earnings reported, and then things happened in, less than 24 hours. But obviously we need to make sure that our bank is FDIC insured. We're able to understand, and there's information out there of like, do our banks have a lot of uninsured deposits? The more uninsured deposits that a bank has, the more likely that these bank run type situations can have, because if deposits are uninsured, people might want to quickly get their money back if there's an issue. Whereas a bank like, Chase, a very modest number of its total deposits are uninsured, right? So they likely don't have to face the same short-term potential crunches that some of these other banks do. How much of their balance sheet is in long-term loans and held to maturity securities? Is it a big percentage of their total deposits? Is it a small percentage of their total deposits? So there's ways to be looking at the underlying banks to know whether they're safe or not. On what you can control is my money below the FDIC insurance limit at these banking institutions? Can I spread my money around so that no matter where I keep my money, it's always below the FDIC insurance limit? And then even there's a number of different resources out there and partner institutions and companies that we know that, from one account, they can give you unlimited or $25 million worth of FDIC insurance coverage from one account. So, what are the things that are within our control to ensure that, we're mitigating risk and managing risk is important.
Yep. Ian, do you have a question or comment?
Yeah. Hey, James, and hi, Matt. Nice to meet you virtually here.
Thanks for being on.
Question for you. So David kind of addressed, you did address it. David had the similar question to me as what I was going to ask, as far as how to evaluate the risk of failure or insolvency of the institution where you're keeping your money. And it seems like you touched on some of those things to really look at. Sounds like we need to look at where is that we're depositing our money, and if it's beyond the FDIC insurance, where is that money who's it being lent to, how is it being invested? Would that be accurate to say?
Yeah, absolutely. 100%. I think, and then you can, there's some things that you can look at on the balance sheet of your own bank. I think if you're going to talk to them, they're always going to tell you that it's good. Everything's fine, right?
Right.
They were telling, colleagues of mine are at First Republic Bank, right? I have friends that work there. We've had clients that have relationships there, and everything's fine, right? Everything's fine. And then
It's
No,
not.
it's not. Until it's not.
it's not, but it's still been for depositors somewhat business as usual. Like, they didn't lose their money. They got to keep banking. There was no downtime. But from that standpoint, it's I think it's up to us to be able to manage risk, and that likely means working with multiple institutions, or even within a bank. Like at certain banks, they have the ability to spread your money around multiple banks from your existing bank account. They don't really talk about that, but they do. Some of them do. There's I forget, there's an acronym, I forget the acronym, but there's an acronym that banks have where it's like one bank has a network of other banks that they're able to take your money and get it FDIC insured all from your existing bank account, but they don't necessarily tell you that. And sometimes that impacts the bank, because as soon as they take it and spread it out, it's no longer as capital on their balance sheet. So they don't necessarily love it, but there's ways to do, some of them have those relationships, even just by staying at one bank. So yeah, it's a little bit of homework, looking at the balance sheets,
Right.
Understanding the company, spreading your money around across various banks are some of the things that we can do.
Is there any rhyme or reason to, if it's a larger institution like a Chase Bank, who I believe they absorbed First Republic, or credit unions or regional banks, is there any kind of framework we should look at, or is it all different and it doesn't matter? We just need to do the internal research.
Yeah, there's some general research out there that I can follow up and share with you on like the health of banks.
Mhm.
You think about the big banks, like if they're letting these they're bailing out these big but smaller ones, what are they going to do for the bigger banks?
Yeah.
And sometimes I guess what we've been seeing is that the biggest banks are the healthiest banks. The biggest banks are the healthiest banks. They don't have the concentration of deposits, the significant wealth of excess uninsured deposits like Silicon Valley Bank and First Republic, which they were lending to a lot of wealthy investors, and a lot of people kept money there who ended up having these uninsured deposits. And so I think overall the big name banks, the Bank of Americas, the Chases, are on its own healthier than some of these regional banks that fueled kind of lending in this more regional, local markets.
Cool. Thank you.
Yeah, absolutely.
So Matt, I had heard that it's sometimes a good idea if, say, you and your husband have an account at a bank and you've got over 250,000, then to put one in your name, one in their name, and have it separate so that you've got 250,000, spread across the board, kind of like what you were just saying.
Yep, absolutely. Yeah. So like a joint account, each person on the account has $250,000. You can certainly have an account in your name, your account in your husband's name, account in the name of your trust, account in the name of an LLC. You can absolutely do that, but there's always, there's opposite impacts, right? If you live in California and you're keeping money in your individual name over 250,000, then those assets are not, they can be part of probate, right? They're not, your trust might not be funded, and then those assets would go through probate. And so then there's administration of having all these different accounts as well to think about. But yeah, different titling can give you more insurance from one specific institution. Absolutely.
Like what you said. Thank you. That's good.
Yep.
And that's a good point that you bring up, Carol. A married couple or two people, 250 and 250, there's $500,000, right?
Right.
Or spreading it out with your LLC or your trust, other entities, without making it an administrative
Nightmare.
for yourself. Right.
Right.
That is
Right.
a nightmare.
Other things, Matt, you think that we should be thinking about, aside from obviously doing our diligence on the company, if we can, check out a balance sheet, things like that. Are there other things that we should be thinking through as consumers or kind of looking at?
Yeah, for sure. There's other cash management options that are available, nowadays. And the other thing that I've always thought about is, up until a couple of years ago, if you wanted to earn any yield, there were these online banks, whether it was, Marcus or Capital One or Ally, they were paying 0.5%. No one else was paying anything. And so at one stage, if you wanted to get any yield and have FDIC insurance and have safety, that the bank, those were the places to go. Treasury bills, they paid nothing. But now we think about, how do we be the bank, right? Or how do we can make more money than what the bank is now giving us. So why do I want to leave my money at the bank? Or why do I want to leave excess deposits at the bank? So the way that we've been thinking about it for our clients and for like our non-working capital needs, like if I don't need money in the next few months or days or weeks or months, why do I want to leave it at the bank if I can now be earning more money safely elsewhere? And so what we find interesting nowadays is that brokerage accounts being invested in something safe, whether it's extremely short-term treasury bills, they don't have the same leverage issues that the banks have. So as we talked about earlier, when I go to the bank and I give them my deposit, all my deposit money might not be there. If I were to go open up an investment account at Fidelity, for example, and I have $5 million in treasury bills, my $5 million in treasury bills is in a segregated thing. It's like in its own little lockbox, so that if in the event that Fidelity fails for some reason, my money is not subject to the general creditors. My investments, my treasury bills are not subject to the creditors of the company, like the bank, like your money is in the bank, like your excess deposits are in the bank. So in my way of thinking, it's like beyond what I need in the very short term, I'd rather be keeping my money invested in a brokerage account or an investment account in some extremely safe security, because if Fidelity fails, my money is segregated assets. It's not being taken and then lent out somewhere else. It's not subject to, the bankruptcy court and the creditors. It's my own money. Those are my own securities. Unless the only caveat to that is unless there's some widespread systemic fraud, which is why Fidelity failed, which is probably unlikely, very, very unlikely. So I think there's other cash management options available beyond just the traditional banks, where we might want to be thinking about keeping our money. One, it's likely safer from that standpoint than excess deposits. Two, you can be earning more money than what the banks are paying you to begin with, and you can have very good liquidity on those options as well. Like you open up a brokerage account, you can get your money out, pretty much like the same day, like you can get it back. You need to sell things and there's settlement periods, but there are those options. And then there's those other options that I shared, where from one account, you can have unlimited FDIC insurance and earn 4% on your money and have next day liquidity. So you can get your money out the next day and be fully FDIC insured on tens of millions of dollars. Those are all decent alternatives to explore.
So would you just kind of recap what those types of accounts are, or, what that looks like?
Yeah, so there's some cash management companies out there. One's called like American Depository Management, ADM. They're out of Wisconsin. So they have a number of different cash management options. You might need to have some type of relationship with them, but it's worth, it's something to consider. So like one of their accounts, it's just like, it's legitimately just a savings account with unlimited FDIC insurance, and it pays like 4%. It gives you interest,
Wow.
which is more than what most regular banks are, and it's completely FDIC insured. And if
What
you
was
need
the name of that? What was the name of that again?
American Depository Management,
Thank you.
I think it's
Let's see if I can find the website while Matt's talking.
I think it's americandeposits.com. And they have different cash management options. And so like for big companies, right, that have, big balance sheets, or individuals or people that are going to need have a lot of, they're going to be building a having a construction project and they got a lot of capital on hand, like they're great sources. And it's usually like next day liquidity, or they have some different options, next day or second day liquidity. So you have pretty good access to your money. So I think there's a few options like that. I think simply having an investment account at one of the larger, brokerage houses, Schwab, Fidelity, those are all, viable alternatives, and you can be investing in treasury bills or short-term treasury bill funds that don't have the same leverage. The segregation, your money is separate. It's not being used by the bank to go do something else with. It's in its own separate place. I think those are definitely.
Sounds like that's the key. So on the treasuries, it's like that money's set aside.
Correct. Exactly. Your money your money in an investment account is segregated from all of the other operations of the brokerage. So if the brokerage fails, your money is still your money. It's not like it is in the bank where anything above and beyond that FDIC insurance limit is not there necessarily. So certainly has a little bit of a nuance. It's like your bank account might not be your safest account in a sense.
Right. The Fed changed its tune. We're going to backstop everybody. Well,
right.
That was just for this season.
Yeah, and those are going to be interesting things to see how that plays out. And like what David said about the moral hazard, right? Like, is that going to now create banks to take more risk potentially? Like, you think about that. Hey, the Fed's now, backing all the deposits. So they'll step in to bail everybody out. So maybe they take more risks with deposits than they have previously to make a little bit more money. Who knows?
That is even more I hadn't even thought of that, but it makes sense, but that is quite unsettling.
Right.
Yes, that makes sense, and it is unsettling. I agree.
Yeah.
Yeah.
What about opportunity in all this, Matt? Is there a silver lining in any of this? Is there, something we could say, hey, maybe there's opportunity here, or things maybe we should look at?
Yeah, I think the biggest opportunity is these times make us have these conversations and start to
nothing else. Kick the tires and question where the heck's my dough.
Yeah, think deeper about it, because we can be complacent. Things are good. There's money. It's floating around, but I think that's the biggest thing.
I think I understand where it is, but not really. But do I care? There's not a problem.
For sure. Yeah. No, undoubtedly. This doesn't necessarily apply to us as just bankers or just like depositors. I think from a business standpoint, to me, all of these issues are likely going to decrease lending. So I think from an investment standpoint, providing private debt is going to be likely a good thing. If you can be a lender now, I think that is going to be opportunities in the lending market to be an investor or to be a lender in the private debt markets, as all these other banks have to pull back potentially. And that's going to create opportunities to be lending to people that need assets with good quality businesses or have strong real estate opportunities, and to help support their projects, because a lot of other capital is likely pulling back due to the issues now. So that's just general. It doesn't mean that we can all go become the lender today or the private debt market. I just think from a business standpoint, there's going to be opportunities to provide capital to people as a lender because of the issues that the banks are having.
David, do you have another question or comment?
Yeah, it keeps coming back to me, the concern of scale of investment. So when you look at the Silicon Valley firms, actually Thanatos, the company that was built on pure fabrication of benefit, and had on its board of directors Colin Powell, all kinds of well-known, potentially, hopefully thoughtful people.
Yeah.
Nobody was looking at the hard questions. And that seems to me to be an inherent risk, more in recent years than in years past, as investments have become less tangible. If you're investing in an office building, you can, and it's in your town, you can go around, you can look at the neighborhood, you can assess the business opportunities and make a reasoned judgment. But man, nowadays it's tougher to do that. And I think we're seeing some tough sledding as a result of that.
Yeah.
Just a comment. I don't know what to do with that.
I'm with you. I don't disagree. The more, like you said, the more the investment is intangible and you can't touch it, see it, smell it, the more complicated it is.
Yep. The more trust is required.
And that's a mentor of mine. He's, one of the most affluent people I know is also one of the most simple human beings I know. And he's always preaching. He's like, the more something's complicated, the more you should run away.
Yeah.
And we're coming up with these investment products and things to put our money in, and here we are on a Zoom call in 2023 talking about how do banks work. Just banking.
It's funny. I at the beginning of this conversation, I pulled up the 1946 Frank Capra movie, It's a Wonderful Life, where Jimmy Stewart lectures, implores the people in the community who are doing a bank run. And they said, "Where's our money?" And he said, "Well, your money's lended over to Joe there for his house."
Great scene. Yep. Your money's in Eric's house. Your money's in Matt's house. Your money's in Dan's house.
Not much has changed in those 76 years or so.
No.
No.
Yeah, no, for sure. And I think, for all of us as investors like you were alluding to, James, like what's within our circle of competence? How do we be objective about the decisions that we're making with our investing when times are easy? There's a lot of emotions around investing, or all these new companies and they're raising money and it's the next best thing, right? But is it durable? Is it sustainable? What price am I paying? It's something, a hope and a prayer for 10 years out that it might make money, and the valuation of the company is 100 billion today, and my kid's lemonade stand makes a bigger profit than that company, right? Like, how do we?
Hey, Amazon's not profitable.
Right? Yeah, for sure. Their cash flow or whatnot. But yeah, those are big things to consider, for sure.
Interesting times.
Absolutely.
Before we kind of begin to wind down and wrap this up, anybody have, final questions or comments or, anything for Matt or just in general?
I think it was good information, and I think that we just all need to pay attention and stay on top of it and know that, just because it's a huge bank and it's, it globally or whatever, that you've got to be careful and you've got to check it out and make sure that you know what's going on.
Absolutely.
Yep.
Much appreciate the perspective, Matt.
Yeah,
Thank you.
for sure. Yeah, absolutely.
Yeah. I was gonna say, Matt, and any I don't know, parting words or last thoughts as we wrap up here?
Yeah, no, I think the conversation was very healthy. I feel that in the grand scheme of things, I do have faith that the Fed and the Treasury, if these bad things happen, they're smart enough to know to not let the entire system blow up. But at the same time, I think there's opportunities for us to take more control of our money and not simply be as complacent, just letting it sit at the bank, and making sure that those relationships are sound and beneficial. And I know it's harder to get that from your bank nowadays. But if you're an entrepreneur or business owner that's on this call, how do you make sure that your bank is there to support you when you need it? And so getting to hopefully develop those relationships, But at the same time, if you don't need you don't necessarily need to keep all of your money at the bank, and you can have more safety and more income being generated outside of it than there previously was a year or two ago. And so those opportunities are there. So I did definitely encourage you to check some of those other alternatives than just leaving excess deposits at the bank, not really earning a whole lot of interest. It's your money.
Yep, it's your money, your responsibility. Well, Matt, thank you very, very much.
Yeah.
What's the best way for people to get in touch with you? If you want to learn more about Matt, or you have follow-up questions, or you're curious about his financial planning practice, I'd encourage you to talk to Matt. Where can we direct folks?
Yeah. I mean, if you have any questions specifically, my email is matt@illuminationwealth.com. Website, illuminationwealth.com. It's Illumination, like the Minions company that created the Minions, Illumination Wealth. Yeah, that's where I am. I like to post a lot of things on LinkedIn. Seems to be a really good community for me to, provide education and hopefully add value in conversation like we're having here. But yeah, reach out anytime. Always happy to be a resource, no matter what.
Great. Well, thank you. Thank you so much for your generosity and making some time for this network. This was a great conversation, extremely valuable. Definitely left me with some things to kind of think about and ponder, and a couple action items for myself. So thank you. Thank you for your talents.
Yeah, thanks everyone for taking the time to have this conversation. Be well.
Thanks, Matt.
Thank you.
Bye all. Bye,
Bye.
James. Thank you.
Thank you.
Recording here.